Hey guys, okay, we're gonna do part B of the worksheet one more time. I don't need your judgment for how I look with it sleeting outside and being 0 degrees. I hope you are equally as comfy and bundled up. So now we're gonna talk about the part A of the chapter was what if a company gives discounts or takes returns on items they sold? How does that affect the income statement is really where we were looking at, those contra revenue accounts. Now we're going to shift to the balance sheet side of things and focus more on the accounts receivables. So accounts receivables are when a company has sold services or goods on account. And we talked about, do you think it ever happens where someone doesn't pay you back? So yeah, it happens all the time, just like it could personally if you loan a friend money. A company could decide to sell something on account and the customer doesn't pay them back. So then what happens? Does that accounts receivable stay on their books forever? No, at some point they have to do what we call write it off and get it off of their books. But to understand that process, for GAAP accounting, which is what we're doing in this class, we're abiding by the rules that FASB has prescribed with GAAP accounting rules. It says there's this matching principle that we've talked a lot about. And so the matching principle says we want to record the expenses that were incurred to help us run our business in the same year as the revenues that were earned that they match up with. So in other words, if we earn revenues by selling stuff, we want to record on the income statement for that year the expenses that were incurred that helped us earn those revenue sales. So one of the expenses we're going to look at in this section is called a bad debt expense. It goes in the income statement, and it's that cost of extending credit to your customers, and when that customer doesn't pay you back, it's called a bad debt expense. It's an expense because that's a cost of doing business. If you decide to extend credit to a customer and they don't pay you back, that's a cost of your extending credit. Hey, sorry, look at my cute, sweet doggy. She's so happy we're all home. Okay, get down, dog. So that's the bad debt expense. Then how do we get that accounts receivable? Do we just cross it out and rewrite the smaller amount on there? And so remember how we learned about contra revenue accounts in part A to reduce our revenue, but we did it in a contra revenue account so we could analyze it. We're going to have a contra account in this section too, and it's a contra asset account because it goes with the asset of accounts receivable. Rather than reducing accounts receivable directly, we're going to reduce it through a contra asset account that goes by a couple of different names. I always abbreviate it as ADA, Allowance for Doubtful Accounts. Some people call it Allowance for Uncollectible Accounts. And so we have to record it to this contra asset account for two reasons, rather than just directly reducing the AR account. One reason is when we make the entry, we don't know which customer is not going to pay us back yet. So because of that matching principle, the GAAP rules say we can't wait until the customer doesn't pay us back. At the end of the year, when we're ready to present our financial statements and we're ready to show a balance sheet that says assets, remember, stuff we have, we've got to present those amounts correctly. And so if I'm Nike, I can't say I've got 500 million in accounts receivables when I know on my past history that I'm not going to collect on 3% of those accounts. That's not fair to state that I've got an asset worth that much when I really don't. So I'm hoping at this point you've watched my video dealing with this. This is just going to be me working through the worksheets. So you do need to spend some time watching my video, reading about this in the chapters, because things like I just talked through, I'm going to assume you already know about, and I'm just going to kind of show you how to account for it now. So I'm going to flip over here. Okay, part B, estimating our uncollectible accounts. I point this out several times because it's a big mistake students make. Remember the contra accounts we talked about in part A, they were contra revenue accounts because they reduced a revenue, so they're going to get reported on an income statement. So contra accounts always have a buddy that they're matched up with. And whatever that buddy is, that's who they reduce. That's who they act contra to. So a contra revenue account would be your sales discounts, your sales returns, your sales allowances, because they reduce revenue. In this whole section, we're focusing on contra asset accounts because its buddy is going to be AR. AR is an asset that's reported on the balance sheet, so you would see this one there. So a lot of you guys have seen this already in your project, and way back when we were doing Eagle Soccer Academy in chapters 1, 2, 3, you noticed accumulated depreciation. That is a contra asset account. Its buddy is the long-term asset like equipments and buildings, but it reduced it. So you reported it on the asset side of your balance sheet, but just as a reduction in assets. So you need to remember that for when you're filling out financial statements on your exams. And then of course in real life too, that it's a reduction of. Okay. I remind you here that your chapter, Even in Connect, does a fantastic job. They have a few key points and common mistakes in each chapter. The common mistakes, they do like a red circle X. I can't remember the key points. It might be green or blue, and I think they've got a key. But anyway, it's a really good way for them to summarize what you're learning in that chapter after you've done everything. Okay, another thing, I know I keep going back to the last section, but students get it confused because there's just so much in here. Remember this last section, we talked about something called net sales, which is of course a revenue, net revenue. You have your gross revenue, you minused it by sales returns, allowances, discounts, you have net revenue, and then you get down to net incomes. Well, we're gonna have another name in this section that starts with the word net, and it's called net AR or net realizable value. And what that is now instead of being on the income statement, we're on the balance sheet. And remember, on the left side of our balance sheet are our assets. So what net AR or net realizable value is it reports our accounts receivables, and it doesn't say so, but that's a gross. And then you say less or minus your allowance for doubtful accounts, the amount you think you're not going to be collecting because some customers don't pay you. And that's what gets you to this net AR amount. It's also called net realizable value. So sometimes looking at them side by side helps you remember. Net sales revenue or net sales is reported on the income statement. Net AR is reported on the balance sheet because one's an asset, one's a revenue. So you need to know all kinds of stuff about that. And really the only way to get comfortable is just work lots of problems with it. Okay, so there are actually two different allowance methods for figuring out how much do we think customers aren't going to pay us. And we only do one main way, and then we learn a other specific way to do it in this chapter. When you get to intermediate accounting, if you're an accounting or finance major and you take that, you'll go in even more detail and learn other ways. So this allowance method says we look at our AR at the end of the year on our balance sheet, and we estimate, hey, in the future, how much of that AR do we think people are not going to pay us? So there's no format or formula that accounting gap rules tell you because every industry is going to be different. Like I was talking about in the prior video, a hospital is going to certainly have more people who can't pay them than a car dealership, because a hospital has to accept any patient who walks in their ER doors, whereas a car dealership does not have to sell to you on credit. So it's going to depend on industry, it's going to depend on the economy, things like that. But you can base it usually on history. Hey, we know historically the past 5 years, 3% of our sales we didn't collect, or we know this year the economy was really bad with COVID. So probably we're going to have more people that can't pay us because they lost their jobs, things like that. But whatever that amount is going to reduce the AR on the balance sheet, like we talked about here, and it's going to increase your expenses on the income statement. So remember how in the beginning of this video, I told you there's an expense called a bad debt expense. So those are your two, we're going to learn how to make journal entries, and those are your two accounts. You're going to have a debit to bad debt expense because we debit accounts when our expenses are increasing. And we're going to have a credit to allowance for doubtful accounts because it's a contra asset account. Assets normally increase with a debit, so they decrease with a credit. So hopefully kind of seeing it on your financial statements will help you when we're making the journal entries. Okay, so in your book, it has an example using Kimsey Medical Clinic. It's an emergency outpatient clinic. And in 2019, Kimsey bills its customers $50 million for care provided. So Kimsey earned $50 million in revenue, but then they billed the customers and said, hey, pay us later. By the end of that year, $20 million remains due from customers. So if we're Kimsey, here's our AR. Of course, they've got a separate AR for every single customer, right? They need to know who owes them what. But altogether, they had $50 million in AR, and at the end of the year, $20 million remains. So $30 million must have been paid off, right? So here we are on December 31st, $20 million remains. Kimsey's ready to create a balance sheet. They need to put AR on their balance sheet of $20 million, like we did here, but it would say 20 million. But now Kimsey has to make an estimate to tell its stakeholders, and that could be stockholders, investors, creditors, whatever, to tell them, oh yeah, I know people still owe us 20 million, but historically we don't collect all 20 million of that. Historically, we don't collect this much of it. So our net AR, or what we really think we're going to be getting, is something less than that. How much less? Well, we're going to look at a couple different ways to figure that out. So the problem would have to tell you as a percentage of AR, because you don't know what Kimsey is. Kimsey says, okay, normally 30% we don't collect. That's huge, y'all, right? If you run a regular business like a car dealership, you don't want 30% of your customers not to pay you. You're not going to stay in business very long. But again, it varies by industry. So this method is called the percentage of receivables method because it's based on our receivables at the end of the year, and the company has a percentage that they know they probably won't collect based on their history. So what is 30% of Kimsey's AR balance? 30% of $20 million is $6 million. What entry does Kimsey record then at the end of the year? So Kimsey is saying, hey, we've got a bad debt expense. That's our debit, because when expenses increase, we record them with debits. It's on the left side of the dealer chart, 6 million. And our credit is to that allowance for doubtful accounts account. Again, sometimes you'll see it called allowance for uncollectible accounts. So do you see what this account is doing? Because it's a credit, if we report this on Kimsey's balance sheet right now, which I wonder, yeah, here, let me go ahead and do this right here. Here's what it would look like. Kimsey would have assets over here on the left. They would list their full AR amount at 20 million. Then they would say less the amount we think we're not going to get, 6 million, for a net AR, or you can call it net realizable value, of 14 million. And that's saying people owe us 20 million. We think based on history, we're probably not going to collect 6 million of that. So really, we think we have an asset worth about 14 million. Is this exact? No, it's not exact. We don't know for sure. So why are we having to do this based on the future? Why can't we just wait until those customers don't pay us back? You know, we say, okay, we'll wait a year and then we'll write it off. Again, because of those matching rules. Because remember, the income statement is getting put out this year too, and we would have this bad debt expense of 6 million on it. So the matching principle, we want the expenses recorded in the year of the revenues that they helped earn. And also because of this asset, we can't go around telling people we've got an asset worth 20 million when we don't. We know it's really only worth about 14 million. So it is a guesstimate. Okay. And that's kind of what I'm talking about right here. So just looking at your different accounts, your accounts receivable started out at 50 million at the beginning of the year, or, you know, during the year, that's what they provided. 30 million must have been paid off. We ended up with 20 million. Our allowance for doubtful accounts is what we recorded right here, 6 million. So I do this kind of in these T accounts to show you guys about contra accounts. If it's a contra account, which this one is, it only exists with a buddy. And whatever the buddy is who it reduces. So see how this is a credit entry and this is a debit? That shows you that net, you've got 14 million worth of AR, net AR, or net realizable value. Oh, sorry, there it is right there. So hopefully that kind of helps you see that. Then what about our revenues? Well, it told us they earned $50 million worth of revenues all year, but they had bad debt expense. I'm just going to write a 6 this time, of 6 million. So on our income statement, we would have revenues minus expenses. And of course, they've got other expenses too, their salaries, their rent, their utilities, whatever. Okay. I mentioned this already. Why do we keep the allowance in a separate account rather than just reducing the customer's AR directly? Well, because one, we don't know which customer is not going to pay us yet. We don't know which customer isn't going to pay. So again, hospitals can't really control that, but most other businesses can. If you know, if Nike knew Academy wasn't going to pay them on some huge shipment of shoes, Nike would never, quote, sell them the shoes, right? Why would you sell a customer something if you know the customer can't pay? Well, we don't know which customer. We just know based on history, 10% of the customers don't pay, like that. And the other thing is we don't know the exact amount. So that's why when we make this entry, we hit or affect the account called ADA rather than reducing this accounts receivable account directly, because we don't know whose accounts receivable to write down yet. We're just estimating. Okay. I'm going to write this here next to this, and I'll kind of harp on this later. And I do in my video where I'm talking to you about this. This is the estimate we make at the end of the year. You record your expense and you put it in, I kind of call this a mystery pool or an estimate pool, ADA. But what happens when we know which customer is not going to pay us back? How would we know that? Well, the customer files for bankruptcy, the customer goes out of business. We've spent a year chasing them and we can't find them anymore, can't get them to pay off, whatever it is. What happens then? Well, now we actually need to write off their AR account, right? We don't want that on our books forever. We want to show, whichever, if it's, say this is Academy, Nike's the business and they've got an accounts receivable for Academy owes us this much. Dick's Sporting Goods owes us this much, and on and on. Well, if we know Academy went out of business, we need to write off their accounts receivable. What would happen then? So we're back to our Kimsey clinic. Assume on February 23rd, Kimsey receives a bankruptcy notice from one of its customers, Bruce Easley. Bruce owes Kimsey $4,000. Remember in 2019, we made an entry. Kimsey allowed for the possibility that some of its customers would not pay them back. Remember that 6 million? And we charged it to bad debt expense at that time. They just didn't know which customer. So when we get to the actual write-off of an account, we don't need to record bad debt expense again. We've already recorded that. At this point, we need to actually write off Bruce's account. So how do you write off or zero out or decrease an AR account? Well, an AR account is an asset account. So we decrease it by doing the opposite of the dealer chart, which is a credit. So I'm going to decrease my AR account here by that 4,000. So what is my debit going to be to? Again, it does not need to be to bad debt expense. We already recorded that. So now what it's going to be to is that estimate pool. I'm going to reduce the estimate pool by $4,000. So the way I look at it, here's my estimate pool, the ADA, that's how I abbreviate it, or allowance for doubtful accounts, or allowance for uncollectible accounts. The way I look at it is I estimate it over here. I'm kind of parking it here temporarily until I know whose account it is. And once I know whose account is not going to pay me back, I remove it from the estimate pool and write off the account directly. So in the case of Bruce Easley, or whatever his name was, we didn't remove all 6 million. His account was just 4,000, right? So we removed 4,000 here, and then we wrote off his account 4,000 directly. So maybe just kind of see an NT account will help you see that better. That's what we're doing right there on 2/23 of 20. So each year, 2 things are done. And here's where you need to understand this, but I'm all about like tips and tricks to help you remember stuff. So you'll definitely have things on an exam. And you guys, this is one thing that even though this seems confusing, especially when we take it a step further, you will probably all run into. So I've been a controller for a pharmacy and we had doubtful accounts where we had to write things off. I've worked for a large nonprofit and we actually had an allowance for doubtful accounts because believe it or not, people make pledges to nonprofits saying, yes, I promise to give you this much this year over this many months. We record that as a type of revenue. Nonprofits are a little bit different in accounting, but you can think of it like revenue. But then sometimes at the end of the year, those people didn't give us the money that they had promised. And so we've got to constantly be doing this. So almost everyone in some kind of managerial or ownership position ends up having to understand about this, even if you're not the accountant. Because the business is the only one that's going to be able to estimate how much you think you're not going to collect. There's no accounting rule that can tell you that. Okay, so notice how we have 2 types of entries here. One was where we made the estimate at the end of the year, and one was where we actually wrote the account off. So again, you need to learn it. You need to spend some time on this, but here's my tip. The estimate starts with the E. That's when you record your bad debt expense. The actual write-off starts with an A. So there's no bad debt expense here. There's only A accounts here. I don't know. Maybe that'll be a tip that can help you. Not sure. So that's what I'm talking about here. Each year, 2 things are done. You establish an allowance at the end of the year for future uncollectible accounts. And then during the next year, you write off the bad debts as they become uncollectible. Here's the next part that's just a little bit harder. So make sure you've got all that so far. Then once again, at the end of the following year, you have to estimate, okay, now what's going to be uncollectible? So remember we started in 2019 with Kimsey. And then during the year, we wrote off some accounts. Here was Bruce's. But what they're telling us is during the entire year, they actually wrote off a total of $4 million. So I'm going to come down here to allowance for doubtful accounts. Remember, we recorded $6 million on 12/31/19. What this problem is telling us that is in all of 2020, they wrote off $4 million worth of accounts. Stop and see what you can tell me about that. Hopefully you can look at that and go, oh, we, being Kimsey, guessed too high. We thought customers weren't going to pay us $6 million. We thought we were going to have uncollectible accounts of $6 million. And we actually only had uncollectible accounts of $4 million. We were left with a balance of $2 million in this account. We guessed too high. What did this do to our net income? If we guessed this amount too high, our bad debt expense was also too high, meaning our net income would be too low. If we have too much in expenses, it made our net income go too low. So does Kimsey go back to the 2019 income statement and redo it and redo, these were my example amounts, but redo, they had 20 million in AR, 6 million in allowance for doubtful accounts, left with 14 million NRV. They had 50 million in revenues, 6 million bad debt expense, so 44 million before other expenses. Do they go back and redo their financials? And no, they cannot. The GAAP rules say we cannot go back and redo this. And so if you're Kimsey, you're like, well, that sucks, man. We showed that our net income was too low. It really should have been 46 million, and that would have made our company look better, right? And we really had more assets than we reported. So what happens is you just fix the problem in the following year. And here's how you fix it. By 12/31/20, they had actually written off 4 million, so that at 12/31/20, they had this much of a balance left in there. I'll come over to AR and we'll look at the next year. So, oh, sorry, this is on the next page. This tells me record the actual write-off in 2020 of all 4 million. Well, we debit ADA of the 4 million. And we credit our actual AR account of the 4 million. So here's our next part next year. Oh, shoot, just tricking. They don't get to that yet. Your book rearranged some things this semester. Okay, that's okay. Keep this page handy. You're going to need it. We're going to find out one more way to estimate for allowance for doubtful accounts. We're still using the percentage of receivables method, meaning we're still going to base it off of receivables, but there's something called aging that's really the more common way. So it says during 2020, Kimsey had billed customers for services that totaled 80 million. 30 million are still receivable at the end of the year, meaning customers still owe Kimsey $30 million. And now one more time, Kimsey must estimate how much they think is uncollectible of that 30 million. So they could use the method we used earlier. Do you remember what we did? We just said 30% times whatever was left at the end. Last year it was 20 million. That's how we got the 6 million. So we could say 30% of 30 million equals 9 million, and that's what they think they're not going to collect. Or they could do the aging method. You do need to know both of these ways. You'll have a problem that looks just like this aging problem on your exam. Here are Kimsey's ARs. Remember I said they don't just have one AR account for 30 million. Here's the 30 million total AR. Kimsey has a separate AR for every single customer that owes them money because they got to keep that straight. Shirley owes us this much, Carl owes us this much, and so on. So an aging says, how long has this account been out that the customers don't pay us? Well, for these amounts, they're not yet due. They must have gotten treated in the last 30 days or so. But for these people, their bills are already 1 to 60 days past due. And these people, their bills are 60 days to 120 days past due. These bills over 120 days. What you can probably deduce without ever having heard this before is that the longer a bill goes without being paid, the less and less likely you are to collect on it. So what you can see down here, and these percentages would have to be given to you on the problem, but that for the people who haven't paid yet because their bill's not due yet, Kimsey says, usually only about 10% of those don't pay. But man, once it becomes almost 60 days past due, 30% of those people don't pay. Once it becomes 120 days past due, 50% of those people don't pay, and 70% of those people. So we take the total AR of the bills that aren't due yet times the 10%, and we say that's 1.6 million. Same here. Bills that are 1 to 60 days past due, you would be given that amount. You would be given the total AR. You would be given the percentage. You just have to say, 9 million times 30% is this. 4 million times 50% is this. 1 million times 70% is this. So how much of this 30 million does Kimsey think they are not going to collect? Well, all of these amounts, that plus that plus that plus that equals 7 million. So this will be the part that you'll do on the exam. You'll have all of this. You will age it and tell me, their estimate for uncollectible accounts is 7 million. Compare that to the way we did it earlier. Earlier, we just said, customers in total owe them 30 million. Times 30%, that's 9 million. So which one is right? The 9 million estimate or the 7 million? So neither one is correct. We don't know yet. These are both guesstimates, right? They're guesstimates based on history and facts, but neither one of them is exact because we're not sure. What we do know is generally the aging is more accurate. You're breaking it down more specifically, but either way is acceptable with GAAP accounting. So as of 12/31/20, customers owe Kimsey the $30 million, and Kimsey estimates they're not going to be able to collect 7 million of it. So they need to make an entry to estimate. See, they need to record in the allowance for doubtful accounts. They need to make that estimate. What entry are we going to make? Well, I'm going to write the accounts down first, and then we'll talk about how to figure out the amounts. When you make the estimate, you go ahead and record the bad debt expense, and you record to your allowance for doubtful accounts account. How much? Well, you think, they just told us, or we just figured it out, 7 million. But it's not going to be 7 million because we had a balance left over in that allowance for doubtful accounts account. I'm just going to copy from here over to here what we had. Remember 12/31/19, we estimated that, but during 2020, we only wrote off that much, so we were left with a $2 million balance. Remember, your journal entries are recording the amounts you need to get you to the ending balance. What do we want Kimsey's balance sheet to show? We want their total allowance for doubtful accounts to show 7 million. So I'm going to say this is the balance needed on balance sheet. Well, if they already had 2, but they need 7, what journal entry do they need to make to this ADA account? I call it all these different things because you need to know all the different terms for it, but that is the same as allowance for uncollectible accounts. What entry do they need to make? Can you tell? So hopefully you can see that they need to make a $5 million entry here, because 2 + 5 = 7. And our journal entry, so I'll say this is the journal entry amount needed to get to this balance. This is one of those adjusting journal entries like you did for supplies. You knew how much supplies you had on hand, and the problem would tell you the ending amount of supplies the company had that needed to be reported on the balance sheet. So your journal entry was the amount you needed to record that got you from here to here. That's what we're doing here. So let's take a step back and look at this and see if this makes sense on our 2020 income statement. Remember, did I write that down somewhere? Yeah. Remember I said on our 2019 income statement that in hindsight, they said, oh, we really had too much bad debt expense on there, right? Well, in 2020, they are estimating that they would have bad debt expense of $7 million. That's what we calculated. But what's going to get recorded on our income statement is only 5 million, because that's the entry you just made right here. That's what's going to get recorded. And does that make sense? And it does, because I said we can't go back and restate the 2019 income statement. We had too much expense here by $2 million worth. So in this year, we're going to have $2 million less that we record than we think. And that's how it's going to wash out and adjust for overestimating last year. And you just constantly do that on a rolling basis. So I just pulled these straight from your book, but it shows you in 2020 that your total AR, customers owed Kimsey 30 million. Their ending balance, not the journal entry we made. Remember, our journal entry was only for 5 million, but the ending balance is 7 million. So that's what shows up on the balance sheet. And then we have a net realizable value. Kimsey saying, people owe us 30, but I think we're only going to realize about 23 of that. Versus you come over here to the income statement, and bad debt expense was only recorded in the amount of 5 million to make up for the fact that last year you guessed too high. Okay, I'm going to do one more problem. This Let's Review is in the book, but I'm going to talk through it. And all I can tell you is you just need to practice this a few times. There's so much in this chapter. So our Let's Review says, community medical is an outpatient health facility that provides health-related services to the community. Many of the patients don't have health insurance. At the beginning of 2021, this company's allowance for doubtful accounts was $100,000 credit. So they're already starting off with a balance in that account. So that was at the beginning. That was on January 1st, 2021. During the year of 2020, they actually wrote off $120,000 worth of accounts. So remember, what journal entry do we make when we have an actual write-off? Well, when we have an actual write-off, that's when we know we can reduce our AR account directly. We actually want to get this off of our books if we're Kimsey, of $120,000, meaning we can remove it from the temporary estimate pool. So that was during the year. So estimate the allowance for future uncollectible accounts at the end of the year, looking at this amount. So here's an aging problem, like I said, you guys would have. So at the end of 2021, they had $600,000 worth of AR that had not been collected yet. And they said 10% of that is usually not collected. So 600,000 times 10% is $60,000. 200,000 of bills are 1 to 45 days past due. And they say, oh, usually we don't get 20% of those collected. So that's 40,000. And then $50,000 worth of bills are 45 days past due. And once customers haven't paid for 45 days, it becomes really unlikely that they're going to pay us. So 60% of those are probably unlikely to be collected. So $50,000 times 60% equals $30,000. So my total estimate is $130,000. I'm going to write total estimate needed. And what this is saying is that on Kimsey's, or whoever this is, Community Medical's balance sheet at the end of 2021, they would report an AR, people owe us $850. They would report a total estimate of $130. Oh, but we think people aren't going to pay us probably $130 of that. Now the accountant, has to make a journal entry to show that, to make this reflect on Community Medical's books. So using your T accounts is the easiest way to see this here. We can't forget, here's our ADA account, we can't forget that this problem told us we started with $100,000 credit here at the beginning of 2021. Beginning of 2021. Yeah, January 1st, 2021. Then what happened during the year? So during 2021, when we wrote off those accounts, we removed 120 from our estimate pool. So what is my balance now? My balance is a $20,000 debit. And what do I want my balance to be? And so that's why I kind of label these things as I do them. It helps me keep clear in my head what I'm looking at. What does this 130 represent? Oh, that's what I want my balance to be in this account on the balance sheet. So I'm going to come down to the bottom and say, I want my balance to be $130,000 credit. So what entry do I need to make to this account to get it from a $20,000 debit to a $130,000 credit? I need to make a $150,000 credit entry, because 150 minus 20 is 130. So I'll say down here, balance needed. And what I have in the rectangle is the journal entry I need to make to get to that balance. So my ADA account is going to be a credit of $150,000. And my debit, because I'm making my year-end estimate, is going to be to record the bad debt expense. So let's stop and talk about that and see if that makes sense. Is that, quote, fair that on my income statement for this year, 2021, I'm going to have a bad debt expense of $150,000 when really I think I'm just not going to collect $130,000? Why is my bad debt expense higher than what I think I'm not going to collect? And it's because the year before we guessed too low. The year before we only had $100,000 in that account, and we ended up writing off 120, 20 more than we guesstimated. So this year we have to record $20,000 more than we think to make up for last year. So the problem we did before this with Kimsey is when we guessed too high, this problem we had guessed too low. So I don't know if I have this on here or not. No, I don't know if I made a copy for you or not. Prepare a partial balance sheet showing AR and allowance for uncollectible accounts. I don't have a ton of room for that. I guess I'll do it right here. On your balance sheet, here's your assets. At the end, so at 12/31/21, Kimsey would show AR of 850,000 minus allowance for doubtful accounts of the balance, not the journal entry we made to get to the balance, but the balance. Our balance sheet shows ending balances in accounts. So minus 130. So that would be what their net realizable value would be 720,000, what they really think they're going to receive. And then again, your income statement would show all their revenues minus all their expenses. And one of those expenses would be a bad debt expense of $150,000. Okay, so the last part of this chapter discusses the direct write-off method, which really this would be delightful if we could use because it's the easiest. It says, oh my gosh, instead of making all these stupid estimates, why don't we just wait until we know somebody declares bankruptcy or until a year has gone by and we know we're going to write it off? And it's because the GAAP rules say that we cannot do that. GAAP says we have to estimate it at the end of the year because of that matching principle on our income statement. And also because it's not fair to report an asset that we have if we don't really have that much of an asset. We're talking about some really big numbers with some of these companies, so it really makes a difference. So that's part B. I'll stop there and we'll do one more video for part C. I told you guys this chapter has so much information in it.